Welcome back to Analyst Bites. Today we are entering the final chapter of our free cash flow series. Our mission is simple: to master the last two variables in the FCF formula. First, we have fixed capital investment, our hardworking robot that keeps production running. Next, we have net borrowing, the magnet that only attracts interest-bearing debt. Once you clear these two, the entire logic of FCF valuation will finally click. No fluff, let's get straight to it. Let's start with fixed capital investment. To truly master this, you need to understand two concepts: CapEx and disposal. Let's use our robot animation to break down CapEx first. CapEx is the actual cash a company pays for new equipment. Look at this screen. At time 0, the factory buys a brand new robot. Its HP bar, or Net PP&E, is at 100. 1 year later, after some hard work, the robot's HP drops by 30. This 30 is our depreciation expense. Now the old robot's net PP&E is only 70. To expand, the factory buys another new robot for 100. This 100 is our CapEx for the year. Here is the trap most students fall into. They assume the change in net PP&E is the CapEx. But let's do the math. The ending PP&E is 170. 70 from the old robot, 100 from the new, and the beginning was 100. So the change is only 70, which is not our CapEx of 100. Why? Because net PP&E is already weakened by depreciation. To find the real cash spent, you must add that depreciation back. Real formula: CapEx equals the change of net PP&E plus depreciation. If you're looking at gross PP&E, it's even simpler. Gross PP&E equals net PP&E plus accumulative depreciation. So gross PP&E ignores depreciation. CapEx is simply the change in gross PP&E. Keep this in mind. With the change of net PP&E, add back depreciation. With gross PP&E, just take the difference. Now that we've covered buying, let's look at disposal, selling of old equipment for cash. This acts as a reduction in our fixed capital investment. Let's look at the final chapter of our little robot. After 5 years, its HP bar is down to 10. The factory sells it to a scrap yard to extract its remaining value. The yard pays us 15 gold coins. This is our proceeds. Since we sold it for 15 while it was only worth 10 on the books, we record a gain of 5. From this, we get a key equation. Proceeds equals net book value of the assets sold plus gain or minus loss. Now let's put all the pieces together to see the full fixed capital investment formula. Fixed capital investment equals CapEx minus proceeds. If we expand both terms, for CapEx, it equals the change of net PP&E plus depreciation plus the net book value of the asset sold. For proceeds, it equals net book value of the asset sold plus gain or minus loss. Take a good look at this full equation. It shows exactly how every dollar is accounted for. You might notice that net book value appears on both sides. Keep that in mind for now as we build the foundation. This is the most detailed scenario you will encounter. Once you grasp this logic, the exam becomes much easier. Now let's dive into some examples to see how this works in practice. Let's start with our first example. This problem closely mirrors how fixed capital investment is typically tested in Level 2. We are asked to calculate the 2025 fixed capital investment based on the provided balance sheet, income statement, and cash flow statement. Using the formula we just discussed, we can solve this using the information from the balance sheet and income statement. If you look at the income statement, it explicitly states that no equipment was sold or disposed on this year. This immediately cuts the difficulty of our formula in half. So in this case, fixed capital investment simply equals the CapEx, which is the change of net PP&E plus depreciation. So the calculation is 1,200 minus 1,000 plus 150, which gives us 350. That's option C. However, there is an even simpler way to calculate fixed capital by looking directly at cash flow statement. You can see that cash paid for the purchase of equipment is listed as 350, and cash received from sale of the PP&E is 0. By simply subtracting these two, we get 350. We arrive at the exact same answer, but it's much faster and more convenient, isn't it? Therefore, in the future, if a question provides all three financial statements, don't hesitate. Always prioritize the cash flow statement to find fixed capital investment value. It will save you from the more complex calculations involving the balance sheet and income statement. Let's move on to example 2. We have the net PP&E for 2 years, the annual depreciation expense, and a gain of selling equipment. Our task is to calculate the fixed capital investment of the year. This is a direct application of the yellow formula we discussed with our little robot. If you look at the expanded terms, the net book value in the capex bracket and the net book value in the proceeds bracket simply cancel each other out. So the simplified formula becomes very clear. Fixed capital investment equals the change of net PP&E plus depreciation minus gain or plus loss. Someone may ask why we need to add net book value in the capex bracket. Let's look at the intuition behind this. The beginning net PP&E includes the asset we are about to sell, but the ending balance doesn't. Therefore, to calculate the true capex, we must add that missing net book value back to the ending balance. This ensures we are making a fair comparison with the beginning of the year. So this is the logic behind including net book value in the expanded capex formula. Now we can apply the numbers to this formula. The change of net PP&E equals the ending minus the beginning, which is 600. And we add the depreciation expense of 800 and subtract the gain of 150. The final result is 1,250. Option A is the winner. Finally, let's tackle a true heavy hitter. This problem, adapted from the official curriculum, is a classic. we are given gross PP&E, accumulated depreciation, CapEx, depreciation expense, and a realized loss on the sale of equipment. Our mission is to calculate the proceeds from the asset sale. The key to find the proceeds is to first identify the missing link, the net book value of the asset sold. So the first step is to convert gross to net. Using the formula net PP&E equals gross PP&E minus accumulated depreciation, we find the net PP&E was 6,000 in 2024 and 6,900 in 2025. Step 2 is to use base logic to find the net book value. Following the beginning plus additions minus reductions equals ending logic. The beginning of the net PP&E in 2024 is 6,000 plus the CapEx, which is 2,500 minus two reductions. One of the reductions is net book value. The other is depreciation expense, which is 1,200. This equals the ending net PP&E in 2025, which is 6,900. Solving this equation gives us a net book value of 400 for the sold asset. Step 3. Calculate the cash. Since the net book value was 400 and the company recorded a loss of 200, which means the proceeds is less than the net book value. So the equation is proceeds equals net book value minus loss. 400 minus 200 equals 200. Option A is the winner. Now that we have the answer, let's clarify a detail that confuses many. Why did we use depreciation expense instead of the change in accumulated depreciation? Think of accumulated depreciation as a complex whole. It contains adjustments for every asset the company has ever retired or sold. It's not a clean metric. However, depreciation expense is a clean flow. It represents only the actual wear and tear for the current year. For our base formula to be accurate, we need that clean flow. So always stick to the annual depreciation expense. After tackling the complexity of fixed capital investment, net borrowing will feel much more straightforward. Let's break it down. The fastest way, as you might have guessed, is using the cash flow statement. Under CFF, simply find the proceeds from debt insurance and subtract the repayment of debt. Pro tip: ignore items like insurance of stock or dividends paid. These are transactions with shareholders, not lenders, so they have zero impact on net borrowing. The second method uses the balance sheet. Net borrowing is the change in both short-term and long-term debt. Crucial distinction here: debt is not the same as liabilities. Liabilities include everything you owe, but debt refers specifically to interest-bearing obligations. Look at our golden magnet. It only attracts iron blocks that carry an interest rate. This includes notes payable, current portion of long-term debt, bonds, and long-term debt. Wooden blocks like accounts payable or other operating accruals carry no interest, so the magnet ignores them completely. Don't include them in your net borrowing calculation. Finally, for forecasting future FCFE, we use the target debt ratio approach we discussed it in the last video. net borrowing equals DI ratio multiplied by fixed capital investment minus depreciation plus working capital investment. If you're still a bit unfamiliar with this formula, feel free to revisit the related examples and concepts we covered in part 2. Now that we've covered the theory, let's jump straight into the example from Omega Company. Our mission is clear. Extract the net borrowing from a set of financial statements to calculate FCFE. First, let's look at the first two items. Insurance of long-term debt brought in 100. This is borrowed money, so it's an addition to net borrowing. Repayment of bank loan principal resulted in an outflow of 40. Since this is a paying back the debt, it's a subtraction from net borrowing. Both of these are iron blocks that our interest magnet can attract. Now look at the next two items. Accounts payable is a non-interest-bearing operating liability that belongs to working capital investment, not net borrowing. Dividend paid to shareholders is a distribution to family members, the owners, so it doesn't fall under the debt category. Therefore, we cross these two out. They are not part of our calculation. The math here is very simple. 100 minus 40 equals 60. The answer is B. Before we move on, I want to take this one step further. Some students ask, do interest payments count as net borrowing? The answer is no. In the cash flow statement, interest paid is categorized under CFO. Since it already affects FCFE through the CFO component, you must not count it again in net borrowing. Remember, net borrowing only tracks the changes in debt principal. We have finished breaking down the FCF formula, but before we move on to the final valuation, we need to cover two critical logic points. The first point is about how financing behaviors like dividends, buybacks, and debt affect FCFF and FCFE. To clear things up, let's look at this diagram. We can set up a glass dome. Inside the dome are the common shareholders, the insiders. Outside the dome are the lenders and preferred shareholders, the outsiders. First, let's look at internal money gains. This includes common dividends, buybacks, or issuing new common shares. Do these affect FCFF? No. FCFF represents the company's core blood-making ability through its operations. It has nothing to do with how you distribute or raise money. Do they affect FCFE? The answer is still no. Many students get stuck on issuing new shares. They think new shares increase the cash available to old shareholders. But remember, FCFE measures the total wealth of all shareholders within the dome. Dividends, buybacks, and new shares are simply moving money between the company's pocket and the shareholders' pockets. It's just a left pocket to right pocket transfer. It doesn't change the size of the total pie or the shareholders' total wealth. Therefore, FCFE remains unchanged. Now let's look at external capital. Consider changing leverage, like borrowing or issuing preferred stock. For FCFF, definitely they have no effect on FCFF. For FCFE, this is a case of outsiders sending money into the dome. So FCFE will increase. Conversely, paying dividends to preferred shareholders is just like paying interest. Money is flowing out to the outsiders, so FCFE will decrease. Finally, Let's take a look at the full FCFE formula at the bottom of the screen. I've included net borrowing, preferred issuance, and preferred dividends, the items that truly impact FCFE. As long as you distinguish the boundary of the glass dome, this formula becomes very intuitive to understand and remember. Let's reinforce this point with two examples. Question 1. Alpha Company decides to use its cash on hand to buy back 50 million in common stock and pay a 20 million special dividend to common shareholders. What is the impact on FCFF and FCFE? Remember the gold coin game inside the glass dome? Whether it's a dividend or a buyback, it's essentially a redistribution of wealth among the common shareholders. While cash has shifted between the company and the owners, there is no net increase or decrease in total wealth for the shareholders as a whole. Therefore, these actions have no impact on FCFE and absolutely no impact on FCFF. The answer is C. Done. Now let's look at an advanced question. This one tests your sensitivity to incremental information. The problem states that an analyst had already calculated beta company's FCFE to be 200 million. However, the company subsequently announces several new actions. We need to determine the revised FCFE. Action 1. Issuing 50 million in preferred stock. As we just discussed, preferred shareholders are outsiders. This is an external capital injection, so it increases FCFE by 50 million. Action 2. Issuing 40 million in long-term bonds. Using the same logic, outsiders are bringing money in, so FCFE increases by 40 million. The tricky part is Action 3, paying pre-planned preferred dividends. Notice that this dividend was already part of the original plan. This means when the analyst first calculated the 200 million FCFE, this amount had already been deducted. Since it was already accounted for, we don't need to subtract it again when processing the new changes. So the calculation is very straightforward. Revised FCFE equals initial 200 plus new preferred 50 plus new debt 40 equals 290 million. The answer is C. Note that we do not subtract the pre-planned preferred dividend. Done. We have finally reached the last knowledge point for FCFF. Keep it up, we are almost there. Please look at the diagram on the left. The PV of FCFF, which is the value of all FCFF discounted 2 times 0. It represents the value created by the company's operating assets. You can think of this as the glowing gears. They are the core operating value of the business. But don't forget, the company might also have assets that are not currently involved in operations, such as idle island or excess cash. These are like locked treasure chests, which we call non-operating assets. The true value of a company, the firm value, is composed of both the glowing gears and the locked treasure chests. Firm value equals PV of FCFF plus non-operating assets. Here is a critical detail. If you need to calculate equity value, you must use the total firm value as the starting point to subtract the market value of that. rather than subtracting it directly from the PV of FCFF. Finally, many students confuse enterprise value with PV of FCFF. So let's look at the formula. Enterprise value equals equity plus debt minus cash. Comparing these two, you will see that the difference between EV and firm value is usually just cash. So if excess cash is the only non-operating assets, then PV of FCFF equals enterprise value. And only if a company has no idle cash and no other non-operating assets will firm value equals PV of FCFF equals enterprise value. They are only equal in this ideal state. Otherwise, you must keep their differences in mind. Let's use one last example to consolidate this core logic. The problem gives us the projected data for Omega Company. The PV of FCFF is 1,000 million. In addition, several items from balance sheet are provided. Our goal is to find the equity value. Remember the gilts and treasure chest formula? Before calculating equity, we must first find the firm value. In addition to the operating part of 1,000 million, we must add back all the locked treasure chests, which include the first item, excess cash, and the second item, idle land. So firm value equals 1,000 plus 50 plus 150, which equals 1,200 million. Finally, we subtract the market value of debt from the total pie, which is 300. And now we got the equity value is 900 million. Option B, done. Finally, after 3 intensive parts, we have officially mastered every concept, trap, and calculation in the free cash flow series. You did it! If you followed the logic across these 3 videos and combined them with some practice, you are more than ready for the exam. Starting with our next video, we are moving into a brand new series, EPS and equity manipulation. You will start with basic and diluted EPS from level 1 and clarify those tricky convertible instruments. Mastering this is crucial because it bridges the gap directly to the share-based compensation chapter in level 2. Just like this series, I will guide you through 3 videos, from basic concepts to advanced logic. I'm Analyst Bites. Every problem here is to help you ace the exam. Every insight is to help you see through the business world. Let's take the CFA out of the textbook and into your life. Thanks for watching. I will see you in the next one. Bye.